Ladies and gentlemen, good evening. I welcome you to our conference call for a presentation on the bank's performance for the fourth quarter and financial year 2018. On this call with me is Mr. V. Srinivasan, Deputy Managing Director. At the end of this presentation, the two of us will be glad to respond to your questions. Earlier today, we shared two presentations on our website. Our quarterly investor presentation, which is what we usually share, as well as a special presentation called FY19 Execution Strategy. During this call, we do expect to refer to slides in both these presentations, so you might want to keep them handy. Let me get straight to the key discussion point of the quarter, which is on asset quality. You might want to refer to slides number 48 through 55 in the earnings presentation for a discussion on asset quality. In this quarter, we have significantly accelerated NPA recognition in parts of the book that had incipient weakness. We have also applied the Feb 12 circular of RBI in a very conservative manner and have recognized a substantial portion of our restructured book as NPA. Gross NPA formation in the quarter was 16,536 crores, of which 13,938 crores was from the corporate lending book. 59% of corporate slippages were from power, infra, and iron and steel sectors. Power sector NPA recognition has increased substantially in this quarter. NPA ratio in this sector has gone up from around 4% at the beginning of the year to 44% now. The slippages came predominantly from our previously disclosed stress book. Of all corporate slippages in the quarter, 90% came from the BB and below pool. Rating downgrades into the standard BB and below book were broadly similar to the last 5 quarters on a net basis at roughly 2,500 crores. At this point of time, we are not changing our guidance and expectation on this rating downgrade cycle. We will continue to watch how it goes, but as of now, we continue to believe that there is another 1 to 2 quarters of the downgrade cycle still left. We have continued to maintain a high provision coverage ratio on NPAs at 65%. With the accelerated recognition that we have done, we believe that the NPA recognition phase of this credit cycle is now nearing completion. The vulnerable book, which can be measured by BB and below rated accounts, reduced by 44% during the quarter. If you turn to slide 51, which is where we have shown the long-term trend on this metric, you can see that BB and below now stands at 8,994 crores, or 1.8% of loans. It is 1/4 of the 7.3% level that it was at 8 quarters ago. I'd also like to state here that the bank's SMA2 portfolio at the end of this quarter was less than 0.5% of loans. This is the lowest level of this ratio that we have had since the start of SMA reporting in 2014. Let me now move to our capital levels. The bank's Tier 1 capital adequacy ratio at the end of FY18 was 13.04% and a CET1 ratio of 11.68%. Slide 59 in the presentation lays out the impact of various items on our Tier 1 ratio in FY18. If you look at our capital consumption trajectory over the last 10 years, you will see that the bank has grown loans at a CAGR of 22% over this period. And in this period, we have consumed, on an average, 55 basis points of CET1 every year on a gross basis, i.e. without taking into account any capital raise. We expect the next few years to be broadly similar in terms of CET1 consumption. You might recall that as a part of our capital raise done towards the end of the last calendar year, we had issued rupees 2,563 crores worth of warrants, which expired in June 2019. If converted into equity, this would correspond to about 50 basis points of CET1 accretion at today's RWA levels. When you put these facts together around the long-term capital consumption trajectory, the expected inflow if warrants are exercised, and the current levels of capital that we have, we believe that we have adequate growth capital to pursue growth opportunities for at least the next 2 years without a need to infuse fresh capital in this period. Let me now discuss loan growth and the trends we are seeing across our business segments. Banking system non-food credit growth continued to be steady and stood at 10.5% for the last fortnight of fiscal 2018, partly aided by the low base of last year. Axis Bank's loan growth was healthy and stood at 18% YOY. The retail loan book continued to grow strongly at 23%, with significant diversification in portfolio mix. If you refer to slide 23, the growth in retail loans in Q4 was led by personal loans, credit cards, and car loans that grew by 45%, 41%, and 27% respectively. All our new engines of growth, like small business banking and education loans, which we've been talking about over the last multiple quarters, continue to see strong momentum. Corporate loan growth was steady at 12%, same as that in Q3, with working capital loans continuing to grow strongly by 63% YOY. In the corporate segment, we continue to focus on 4 elements: reduce concentration risk, build a higher rated lending book, increase the share of working capital loans and transaction banking revenues, and prepare for a move towards deeper bond markets through our DCM franchise. In line with these focus areas, you will notice on slides 42 through 46 that the incremental sanctions that we have made have been consistently to better rated corporates, 86% to those rated A or better. In our corporate book today, 77% of non-NPA outstanding exposure is to companies rated A or better, compared to 68% a year ago. You will also notice that the bank's exposure to our top 20 borrowers as a percentage of Tier 1 capital has been steadily declining and now stands at 121% at the end of this year, down from 287% at the end of financial year 11. Our SME loan growth improved during the quarter and stood at 19% YOY, partly aided by a slightly suppressed base in March 17. The growth was broad-based as term loans and working capital both grew by 28% and 17% YOY respectively. Share of working capital to overall SME book currently stands at 77%, and the focus here continues to be on building a high-rated book. At present, 88% of non-NPA outstanding exposure in this SME book is to clients rated SME 3 or better. Let me now move to a discussion on our retail franchise. Our strong retail franchise continues to deliver. The overall deposit growth for the bank during the fourth quarter stood at 9% YOY, influenced by the high base of last year. On an average balance basis, deposit growth was 11% YOY. CASA deposits on a daily average basis grew 18% YOY and comprised 46% of total deposits. On a period-end basis, savings account and current account balances grew by 18% and 10% YOY respectively. On a daily average basis, they grew by 16% and 23% respectively. Overall, our CASA share in deposits stood at 54% at the end of the quarter. CASA and retail term deposits continue to form a strong base and stood at 84% of total deposits, up by 281 basis points YOY. Term deposits grew by 4% YOY, with retail term deposits growing faster at 11%, while wholesale term deposits declined by 7% YOY. Slide 17 of the earnings presentation highlights the growth trend in retail fees over the last few years. At the same time, retail fees have increasingly become more granular and annuity-based. The share of fees from cards has been steadily inching up from 26% at the end of FY13 to 38% at the end of FY18. Card fees grew strongly by 30% YOY in financial year 18. Our internal customers on the deposit side continue to be the mainstay of the bank's strategy for sourcing retail lending customers. 71% of our new originations on lending in Q4 was from existing customers. 97% of the bank's credit cards and 74% of personal loan originations in the quarter were from existing customers of the bank. 51% of the overall sourcing happened through our branches. Given this internal sourcing strategy of ours, we believe that branches remain essential for new customer acquisition and hence continue to make investments in developing an extensive branch network. We opened 114 branches during this quarter with a total network of now 3,703 branches. However, the newer branches continue to get smaller in size. Our leadership position in the digital payment space continues. If you refer to slide 29, you will notice that the bank has a strong market share across most digital payment products. In the mobile banking space, the bank continues to rank among the top 3 players, both in terms of transaction value and volumes, as per the latest RBI data. The bank had 4.5 million credit cards in force at the end of the quarter, making us the 4th largest credit card issuer in the country with a market share of 12%. Credit card spends in the 4th quarter increased by 54% YOY to 13,167 crores, with debit cards growing by 1% YOY to 8,678 crores. The bank is the 2nd largest acquirer of point-of-sale terminals in the country, with an installed base of over 0.49 million POS terminals. We also continue to witness strong traction and adoption of digital channels by customers. If you look at slide 33 in the earnings presentation, you will see that 58% of the bank's active customers are digitally active. 42% of mobile banking customers prefer to use only the mobile app in interacting with the bank. Mobile banking logins are now almost 6.5 times that of internet logins. These are data points that make us increasingly confident that dominance in the mobile space is a must-have for banks in the future. If you flip over to slide 35, these highlight our capabilities and strong positioning in the UPI space. We are among the top 3 payment service providers in the NPCI's UPI ecosystem and currently have 11.5 million virtual payment addresses created across apps. In the 4th quarter, Axis Bank processed 83 million UPI transactions, amongst the highest in the industry with a 17% market share. We currently have 13.95 million unique registered customers. Moving to the bank's earnings profile, I request you to refer to slides 12 through 15 of the earnings presentation. NII for the quarter was flat at 4,730 crores, mainly on account of high slippages during the quarter. For the full year FY18, NII was up 3%. The net interest margin for the quarter stood at 3.33%, with domestic net interest income at 3.59%. Fee income growth for the 4th quarter was muted on a YOY basis, but grew 9% QOQ. For the full year, fee growth was a tad better, with a healthy growth of 12% YOY, and constituted 30% of operating revenue. Retail fees continues to be an area of strength, with a robust growth of 22% and constituted 48% of the total fee income. Corporate banking fees in FY18 degrew by 13% YOY. Trading income for FY18 stood at 1,617 crores, down 52% YOY. Operating expenses growth for the quarter and for the full year stood at 14% and 15% YOY respectively, moderating down from the highs of 21% YOY growth reported in FY17. Operating profit for FY18 was down 11%, driven by lower growth in NII and treasury income. Provisions and contingencies for the quarter increased by 178% YOY and 155% QOQ to 7,180 crores. For FY18, the provisions and contingencies stood at 15,473 crores, higher than the 12,117 crores witnessed in FY17. For detailed provision breakup, you might want to refer to slide 62. Net profit for FY18 declined by 93% YOY on account of the higher provisions that you saw in this quarter. Return ratios have clearly seen moderation due to higher impact of provision costs. Annualized ROE and ROA stood at 0.53% and 0.04% respectively. Finally, I'd like to discuss the bank's business outlook for FY19. For this, I would request you to refer to the presentation on FY19 execution strategy. In this presentation, we have tried to lay out the 4 vectors that the bank would like to focus on in terms of our strategy and what we would like to deliver in financial year 19. If you look at slide 2, you will see the 4 vectors of our strategy identified for this year. Normalize credit costs, deliver profitable growth, enhance capabilities, and invest for the future. Our top vector of delivery this year will clearly be normalization of credit costs. The accelerated recognition undertaken in this quarter will certainly help in that regard, as will the high provision coverage levels we have at this point. On incremental credit underwriting, we would like to continue shaping new originations in corporate lending towards lower risk businesses. As we look towards the economic landscape in the country today, we feel increasingly confident about our ability to deliver growth in lending, and not just on the retail side, but also increasingly on the corporate side. Clearly, there are signs of pickup in investment climate. The IBC-based resolution processes are driving significant loan consolidation-led demand. And of course, as in prior years, the consumer class continues to be healthy. So the opportunities for growth on the lending side are abundant. Our capital levels make us confident that we can participate in this growth pickup as it plays out this year. Needless to say, our deposit franchise needs to continue to deliver to help us fund the large loan growth that we see in front of us. And we need to eke out more on the cost efficiency front. These will be key focus areas for us on the second vector of delivery for FY19, what we are calling deliver profitable growth. The third vector we plan to focus on this year is enhancing capabilities. In particular, we have identified 2 key focus areas for the year: a heightened focus on operational risk management capabilities and a talent and tech-driven reinvention of our corporate bank. The fourth and final vector of delivery in FY19 for us would be investing in the future. There are 3 areas on this front that we have identified as clear differentiators of the bank that require continued investment: digital capabilities, analytics, and our subsidiaries. So that, in a nutshell, is the summary of what we plan to execute on and what we hope to deliver in terms of strategy in FY19. In terms of financial outcomes, our outlook for FY19 is broadly as follows. We expect new NPA formation to reduce quite significantly from FY18 levels. We are at this point of time continuing to look for credit cost normalization by second half of this coming year. We will continue to watch the environment, particularly in terms of the resolution space, to update that as necessary. We expect loan growth in the high teens to 20%. And as I said before, we expect growth in both the retail and the corporate segments in this year. We expect CASA growth in the high teens. We expect margins to be steady around FY18 levels, unlike what has happened in the last 2 years where we have seen continued compression. In the medium term, the bank expects to achieve an ROE upwards of 18%. And in this year, you will see us take a big step forward towards that goal. As I close, allow me to re-summarize some of the key themes. With the accelerated recognition this quarter, the NPA recognition phase of the cycle, we believe, is nearly complete. Our capital position continues to be strong, and we do not expect to need any infusion of capital for at least the next 2 years. We expect strong growth opportunities next year on both the retail and the corporate segments. We have clearly defined 4 vectors of delivery in terms of the bank's strategy for FY19. We now have, we believe, the capital, the growth appetite, and the balance sheet strength to pursue substantial opportunities in the coming year. With this, I come to the end of my comments, and at this point, Srini and I would be glad to take your questions.
Thank you very much. We will begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
How many are on the call?
The first question is from the line of Maruk Adajania from IDFC Securities. Please go ahead.
Yeah, hi.
Hi, Maruk.
Just in terms of slippages, so most of these slippages would be in the substandard category because that will determine the provisioning going ahead in the next year, right? So just a clarity on that. And when you say the credit cost will normalize in second half this year, normalize to what percent level? I mean,
sure.
To the old level or?
Sure. So, Maruk, on your first question on what's the level at which we have made, essentially what I'm interpreting your first question as what is the amount of provision you've made on the new slippages that have happened, and in effect, is there a lot of sort of follow-on provisions to come on that pool? Right. If you see the provisions we have made this quarter, we have made 7,100 crores of provisions on a net basis on a net increase of about 13,000 crores of NPAs or net new slippages. So clearly we have provided upwards of 50% on the new slippages that have happened. So no, I don't expect there to be a lot of follow-on provisions coming from this pool. And on your second question, which is what does normalization look like, we have continually talked to you all about our long-term credit history, about the last 15, 16 years. And with the significant credit cost in this quarter, you will see that long-term trajectory, that 17-year trajectory, now reflects a long-term average of 110 basis points. Now, so somewhere in that 100-110 range is what we believe is long-term normal, and that's broadly what we mean when we say kind of return to normalization.
Thank you. We'll move to the next question, which is from the line of Nilang Mehta from HSBC Global Asset Management. Please go ahead.
Hello.
Hi. Hi, Nilang. Can you hear me?
Mr. Nilang Mehta, your line is in the talk mode. Can you please unmute it from your end?
Yeah. Hi. Can you hear me?
Yes, Nilang, we can hear you very well.
Yeah. Hi. Thanks for taking my question. My question was more regarding management and with light of the 2019 execution strategy. We have been hearing different news flows on churn in the corporate side of your bank in terms of management bandwidth. If you could elaborate, how do you expect to reinvent the corporate bank in light of these challenges? And obviously, the Shikha's tenure now cut short. How do you look to execute the strategy in terms of some vacuum or some uncertainty?
Yeah, I'll take the second part of it a little bit, and then Srini has a lot more to say on the corporate side. See, one of the main reasons, Nilang, why we want to specifically talk about our FY19 execution strategy is, irrespective of kind of leadership movements at the top of the house, we as an organization want to make it very clear where we stand as far as FY19 is concerned, and as a top leadership team, what we are all committing ourselves to in terms of delivering for FY19. And the four vectors that you see here are a collective commitment of the top management of the bank, and are intended to give you the investors the confidence that there are some specific things that we are planning on delivering and working towards in FY19, and hence the Shikha movement question doesn't necessarily have a kind of direct bearing on it because we are all collectively committed to it. On the corporate bank, Srini has thoughts.
Again, the same thing. I think what we are saying is the top management is stable. I think we had one change in the corporate bank side. We have a new head of the corporate bank. And other than that, the leadership is stable. And across the bank as well as in the corporate bank, the teams are stable. And as Jairam is saying, that we're committed to delivering whatever we put out in terms of what we want to execute for FY19.
Srini, can you elaborate on your new hire on the corporate bank side and the potential there?
Yeah, we have hired Sundaresan, who's joined us from Standard Chartered Bank, and he's joined us early April. And Siddharth is moving outside the bank, and he's currently on gardening leave.
Okay. Considering, Standard Chartered was the only foreign bank which had massive NPAs on the corporate side, the corporate banking head from there seems to be going in the same direction where we were in the past. So it seems not very comforting, actually.
I think, that is your call. But again, we've done our diligence, and we believe that's the right thing to do for the bank.
Okay. Thanks, Srini. Thanks, Jairam.
Thank you, Nilan.
Thank you. The next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi.
Hi, Nilanjan.
Hey, could we have, a couple of data points? I was just looking at the slide 52, and if you can, help me tally a couple of numbers. So, we started with a gross NPA of, let's say, 250 billion and non-stress, non-NPL is about 160. And I think last quarter you said there's about, 50 billion of non-funded linked to the BB and below. Could you tell me how these numbers stack up? And additionally, for this quarter, for Q4 and Q3 as well, could we have the non-funded book which is already, whose funded part has already become an NPA?
Yeah. So the non-funded book in the sort of the non-NPA pool is now 2,400 crores, 24 billion rupees, which was upwards of 50 billion last quarter, is now 24 billion.
Right. And how much is now linked to the whose funded is right now is an NPA? Do we have that number?
Sorry, say that again.
I mean, the non-funded to those corporates whose funded has already become NPL.
Oh, 1 second. Let me just grab that data. It is roughly 1,000 crores.
Okay, and how was this in the December quarter?
I don't have that readily at hand.
Okay. And second question. When you talk of SMA2, which is less than 0.5% of loans, do you mean the gross or the net loans?
Sorry, what is the difference? You mean provisioning?
Yes. Because provisioning is obviously a very large number. That makes a very big change.
No. The denominator. Oh, the denominator is gross customer assets.
Gross customer assets, not five.
Sorry?
Okay, it's basically less than 0.5% of gross customer assets.
It is less than 0.5% of gross customer assets. That's right.
Okay. Thanks. I'll come back for more questions.
Thank you, Nilanjan.
Thank you. The next question is from the line of Vishal Goyal from UBS Securities. Please go ahead.
Hi, Jairam.
Hi, Vishal.
So the question again is on 52. Just any sense on what is the breakdown of this 9,000 crore, which is left, 9,000 plus, I think, 2,400, which is non-fund? Sectoral breakup?
Sectoral breakup. Let's continue with the call and see if I can get it.
Sure. And the other thing is, if you could just give us the movement of this particular watch list, from last quarter, wherever we left, because I think you used to give that very nice slide earlier, where you show the movement, what was the total number last quarter, and how that number basically has changed to now 9,000. Because there seems, some deletion, some addition, and since you are saying 90% of the corporate NPA came from BB and below, so either there is a 70 billion kind of addition to the BB and pool. Is that the right way of looking at it?
Right. There's a lot of sort of put and take that has happened here. Firstly, remember that any upgrades that happen during any quarter, upgrades from NPAs, end up going back to sit in BB, right? So all the upgrades that we have had during the course of the quarter end up going back there. Our downgrades from BBB to BB in the course of this quarter were roughly similar to what we have seen in the last 4 or 5 quarters, roughly 2,500 crores. I think I mentioned that in the in my opening remarks. So that hasn't changed. What you're seeing is that of the total slippages, there was and maybe this is we have not ever shared that number very clearly, but let me just sort of put it out there. In the BB and below pool, till last quarter, the accounts that were there in BB and below Also, a lot of them were SDR, S4A type accounts, and there were investment instruments in SDR, the equity instruments that were also associated with them. So when these accounts became NPA, all those investments became NPA as well. That is about 10% of the total slippages in this quarter. Roughly 1,400 crores is that SDR, S4A related equity instruments. So all of that, and since there is nothing more of that nature left in the book, so the investment part of the BB book, which was 1,400 crores last quarter, is near zero now. So that 10% comes from there. And then there is some sort of, and then there is about 10,000 crores of slippages from the opening pool, which is about 90% of the total slippages. That is sort of 10,000 crores. And there is some upgrades coming from NPA into here, and 2,500 crores, roughly give or take 2,500 crores of net increase. That's the sort of overall math of how we go from 16,000 to under 9,000 in the course of this quarter. While I'm at it, the overall pool, the vulnerable pool, if you look at the sectoral distribution, 24% of this is power, and another roughly 15% is infra, and another about 20% is other metals. And the others there is a longer tail.
Okay. And sorry, one last question if I can, on this downgrade, which is being consistent at 25 billion roughly. Now, how do think about that?
Yeah. So the large accounts, Vishal, a lot of the large accounts are kind of done. As we look at the downgrade pipeline, I've been saying this for the last 2 or 3 quarters. That we first said there are 4 more quarters of downgrades left, and we said 3. Now I think there are 1 or 2 quarters of downgrades left. Let's see how much. There is a little bit left, but maybe not more than a quarter or 2. But I wouldn't say that we are fully done with the downgrade cycle just yet. As you might see in one of the slides, like in the power sector, I think we've got this written somewhere, that in the power sector we have another about the power sector is about 10,000 crores. And about 35% of it is, so about 3,500 crores, is rated BBB. I wouldn't be surprised if out of that 3,500 you see some more downgrades into BB coming up over the next couple of quarters.
Okay.
But I think we have only about a quarter or 2 more left, Vishal, of the downgrade part of the cycle. This quarter, for the first time, we actually saw a couple of accounts upgraded from BB out to BBB. We haven't seen that in a long time. So the fact that we saw the first upgrades is probably the sign of a slowing down in the net downgrade cycle as well.
So how much was the upgrade in the quarter? Sorry, from the watch list?
Oh, from the watch list, nothing. Well, from the BB,
yeah.
It was below 1,000 crores, Vishal. It's not a huge number.
Okay.
And there were only 2 accounts. But as I'm saying, we have not seen any in a long time. So even these 2 accounts seems like something.
Okay. All the best, Jairam. Thanks.
Thank you, Vishal.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential Asset Management. Please go ahead.
Hi, Roshan.
Yeah, hi, Jairam. Hi, Yasri. Hi. Yeah, so same question, again going back to the question that Vishal was asking. So about 12,500 crores is the slippages from the stress pool, right? Now,
it is the rating migration downwards from BBB to BB, yes. Can you hear me?
Yeah, I can hear you.
Yeah.
It is, so my calculation suggests about 5,400 crores of downgrade from or inflow into the BB and below bucket.
Yeah, so out of that you need to take out whatever was recovery and upgrade is coming from below, not from above.
Right, recovery and upgrade is amount is how much into this pool, into this bucket?
So, roughly 2,500 crores, give or take.
All right. And so, okay. So what is the total amount which is flowing into the BB and below bucket outside of the upgrades or outside of the positive flow? What is the negative flow into the BB and below pool? All put together.
See, maybe I'm not being super clear here. About 2,500 crores comes from top, about 2,500 crores comes from bottom, and the rest is slippages.
Okay.
I mean, give or take. This is broad math, but that's broadly it.
Sure. And can you just comment a little bit on the retail and SME slippages as well? That seems to be a very high number.
Is it? It's not actually. Like we've, if you see numbers in retail, etc., they are, pretty much at the same level, if not lower than what they were in the last quarter. On a total basis, we are looking at a sum of 491 crores. So in retail, and about 67 crores in SME. So no, they're not actually large numbers at all.
Okay. Thank you so much.
Yeah. Thank you.
Thank you. We would request participants to limit your question to 2 at a time. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah. So again, coming back to the slippages outside of the corporate book, so that seems to be somewhere around 2,600 odd crores. Maybe I think net slippages
on a gross basis. On a gross basis, yeah.
Yeah, so on 2,60,000 crores of maybe the ex-corporate loan book, it's like 2,600 crores of slippage, which is like 4% kind of a run rate. So that definitely seems to be higher than what has been there earlier. So anything to read into it, particularly in this particular quarter, or any product segments which are throwing in this kind of a slippages?
Kunal, you might recall that till a couple of quarters ago, we never disclosed the gross and net separately, particularly in the retail segment, where we used to only talk about net. The reason being that in retail, the delta between gross and net tends to be very, very high. A large amount flows into gross, and a very large amount actually gets recovered, and so the net amount is always small. Only in the last 2 quarters have we actually started disclosing this metric, and you will see that what you're seeing now is fairly consistent. The delta between gross and net is always high. A lot of money actually does get recovered within the course of the period in retail in particular, and that's why you see this. It's nothing out of the usual. The net slippage ratio in retail plus SME continues to be very much in control.
Okay. And if you can give the movement in NIMs the way we used to give it earlier, so maybe how much has been the interest income reversal in this quarter?
Yeah, we killed that slide this quarter, didn't we? There is a meaningful reversal, as you saw. I mean, you can imagine we had 13,000 crores of net slippages, so the delta is the delta is meaningful. I don't have the number readily at hand, Kunal, unfortunately.
No, because the only thing is maybe today we are at, in terms of the exit quarter, it is 3.33, and again, you highlighted NIMs to be somewhere around FY17 level of 3.45. So
FY18 level.
FY18 level of 3.45. So that again seems to be like hardly like 10-15 bips kind of an improvement, and I think in this particular quarter, interest reversal should have been much higher. So are we guiding maybe structurally, otherwise X of maybe the slippages, NIMs are trending down?
No, actually, X of slippages, NIMs, if anything, are trending up. I don't think there is any structural pressure on NIM at this point. The interest rate structure is going the other way, not in terms of compression. And you're right, the net the NIM compression would be about give or take about 10 basis points for slippages in the quarter. On a QOQ basis. So you're right. There is that. There is no science to margin guidance. So you can make your own assumption, and it will probably be better than ours.
Okay. And lastly, in terms of fee income, so you have highlighted 2 reasons why retail fee income has been lower in this particular quarter. But how are we looking at the overall fee income trend in FY19? And was this the only 2 reasons why retail has been like such a low fee income? Yeah,
I mean, those are the 2 big reasons why why we see in retail. There is also some internal changes in terms of classification, but really those are the 2 main reasons. But overall on a fee basis, fee broadly in line with or maybe just slightly below advance growth is what you should expect to see next year.
Okay. Yeah. Thanks a lot.
Thank you.
Thank you. Request participants to please limit your question to 2 at a time. The next question is from the line of Sri Shankar Radhakrishnan from Prabhudas Lilladher. Please go ahead.
Hello.
Hello.
Hi, Shankar. How are
Hello?
you? Hi.
Hi. Jared, a quick question. You mentioned about what is the kind of an exposure that we still have in the power sector. I saw the presentation, but all this outstanding on the watch list, is it already in production or is it still in work in progress or still to be completed?
The power sector, the total exposure that we have is about, funded exposure that we have is 9,700 crores. Kind of most, very little of it is under construction. Most of the under construction stuff is now slipped. The total power sector NPA ratio in this quarter moved to 44%. So clearly everything that was stressed and whether there was whether the project had not been completed, etc., is all gone to NPA status. But we do have some slightly more challenged projects here, but nothing as challenged as some of the stuff that we've had in the past, where there were challenges on project completion, on PPAs, on coal blocks, etc. So these are clearly the better of the lot, but still, as I mentioned before, about a quarter of them are in double B and about a third of them are in triple B. So it's not like these are rocking assets, but all the kind of the worst pool of this has now been recognized as NPA. Hello?
Restructured. Hello, can you hear me?
Yes.
Can you hear me?
Yes.
Yeah. If I had looked into the earlier standard restructured plus your SDR and SNA, etc., which probably was not in the NPA bucket, that as a percentage of your total advances, how much is it today? Is it 1.8% what you have given?
Yes. I mean, that is the math that we've shown on slide 52, right?
Yeah.
Where we have looked at all the different kinds of vulnerability, netted them off against each other, and then looked at them against customer assets. Now, if you want to look only at the restructuring dispensations, which is CDR, SDR, S4A 525, and outside SDR, if you just want to look at those and see how much are they as a proportion of customer assets, that's on slide 51, and that's 40 basis points.
40%. Okay, if I may push in a last question. When you say that you mentioned that you got the first quarter and second quarter also, probably you may see enhanced credit cost. So if you exit FY19, say third and fourth quarter, by fourth quarter, where do you see your ROA and ROE going up?
We are not providing specific guidance on ROA, ROE here. It so much depends on what happens to the recovery and resolution environment. The numbers can be wildly off. So we don't want to hazard a guess at this point.
Okay. Thank you. And all the best.
Thank you.
Thank you. The next question is from the line of Anand Ladha from HDFC Mutual Fund. Please go ahead.
Hi.
Hi.
On the power side, so I understand that bulk of the NPA this quarter happened under construction project. Can you give any color, like what is the resolution for this project? Is the bank has to make 100% provision on the under construction project?
No, I think the resolution mechanisms are on. I think you have seen interest in some of these power projects that clearly there have been some bids. If you look at some of the projects which we have gone through a process, clearly there are bids at different levels. Clearly there would be haircuts, but there is possible resolution happening. Actually, if you look at tariff rates, I think clearly tariff rates have moved up. So to that extent, I think the interest is coming back, but there would be haircuts as far as the sector goes, and clearly reasonable amount of resolution will happen.
Okay. So my question specifically was under construction project. Do you see banks coming together, the consortium of banks coming together and completing the under construction project, or they will be left where they are?
Most of our projects, the large projects, have completed under operation, possibly not running because of coal or PPA.
Okay. And second, sir, when you say second half the slippages will normalize, provision costs will normalize, and in first half the slippages will remain a little bit elevated, are you factoring in any resolution in the NCLT in your assumption? Or
see, I think when you talk of slippages, we are basically saying that from what you've seen over the last year, fresh slippages are going to be lower. The resolution process, what it entails and what will happen is something which is getting increasingly difficult to predict. Once we see the first two resolutions happen, I think a level of comfort will be there in terms of predicting the future course. And that's why I think we're being a bit more conservative in saying the second half will possibly be the place where we will see credit cost moderate.
Okay. So you also mentioned the long-term slippage, credit cost assumption is 110 basis point to 100 basis point. But if I look at your loan book now, almost 50-60% of the loan book has become retail SME, and there the credit cost should be lower. So in that case, why, as compared to historical level loan book composition, so normalized credit cost should be significantly lower than 110 basis points.
That's a fair point. I think the data that we share with you all is unmodified data. We are not adjusting it for business mix. So on an unadjusted basis, the just simple arithmetic average of the last 17 years of credit cost comes out to 110 basis points. You're right that if the business mix has shifted towards the lower credit cost businesses, then the adjusted expectation should be a little bit lower. We will see as that as that plays out.
Okay. And lastly, you just mentioned that UK subsidiary of yours has not been audited, or the audit has not been completed. Can you give some color? What is the size of the UK subsidiary book, loan book? Was there some part of the watch list also sitting in there also?
No. It's a subsidiary. So none of our loans actually sit there. It's a separate company. It's a fairly small one. So it's not material from an overall perspective. Essentially there are some sort of procedure or process issues due to which their audit did not get completed.
And can you just give the breakup of your recovery and upgrade? This quarter it's almost like a large number, 4,000 crore rupee. Is there any lumpy element in that?
There were a couple of lumpy assets, but I can't tell you more than that. There were two lumpy assets.
So what could be the proportion of that?
About half, let's say.
Okay, and the balance half was very granular?
Yes.
Okay, thank you. That's so much.
Thank you.
Thank you. The next question is from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Hi, Manish.
Hi, Jairam. Jairam, you haven't given any details about your subsidiaries' performance this year. If you can just share some of that, please.
Yeah, at this point we're not ready to if you saw our disclosures, we have today declared the standalone financials. One of our smaller subsidiaries, Axis Bank UK, has not completed its audit process yet. So today we did not adopt the consolidated accounts. We will do that over the course of the next few days, and then I'll share with you a lot more information, and we will put up that on the website as well on the subsidiaries information that we usually share.
So you're not even sharing for Axis Capital, Axis Securities, etc.?
No, we have not adopted all the subsidiary accounts. It would be inappropriate for me to talk about it.
Okay. And just coming back to your NPL, especially the BB book which is pending. So you have like 9,000 crores plus 2,400 crores of the non-funded book, right?
Correct.
And I think to an earlier question also, you were to give the breakup of this book. Would it be fair to assume that all the power exposure is a part of this book now?
Not all the power exposure. About this
24%.
About 24% is of this list is power, okay. And 15% is infra, and another 20% is like iron and metals.
Okay. And last question, you have a decent provision coverage. Are you comfortable with this coverage ratio, and should we assume that this is the kind of coverage ratio that you will maintain?
Yes, Manish, we have been fairly consistent in saying that we want to be in the 60 to 65% kind of band on provision coverage. In this quarter, while we had a lot of new NPA formation, we decided to retain provision coverage at the top end of our range, which is at 65%, which is what we have done. We continue to be comfortable with that 60 to 65 range.
Okay. And lastly, as you are saying, I think the general interpretation is that the credit cost should be higher for the next 2 quarters, and thereafter it should go back to normalized credit costs, which you refer close to 100 basis points. Fair?
I think that's fair.
Okay. Thanks so much.
Thank you. There was, while we wait for another question, there was a comment earlier about how much of our power exposure is under construction. And I was just looking at one of the decks that we have, in one of the prior quarter decks, we have talked about this. 2 quarters ago, that proportion was about 13%. And now in the standard assets, it'll be single-digit percentage, if at all, of under construction. Sorry, Margaret, back to you for your question queue.
Thank you. The next question is from the line of Venkatesh Manjari from Pictet Asset Management. Please go ahead.
Hi, Jairam.
Hi, Venkatesh.
I've got a couple of questions. First one, I'm referring to your presentation on FY19 strategy. So you've spoken about the reinvention of the corporate bank. Can you just elaborate this? What is the new Axis corporate bank going to look like? What are the products? What are the what sort of profitability and stuff like that?
So I think we've been talking about this clearly in terms of 2 things. One, in terms of the credit side itself, the loan mix in terms of working capital versus term loans, trying to change that mix. It was term loan heavy, trying to make that more balanced. That is one effort which is on in the corporate bank. Second is in terms of credit income to non-credit income, or what we call flow-based revenues, and trying to make the flow-based revenues a higher proportion of the overall revenue pool of the corporate bank. I think these 2 would be and of course third is digital. I think on the transaction banking side, we made a lot of investments on the digital side to make sure the value proposition we have across all transaction banking products, whether it is trade, FX, or cash management. I think how to provide an integrated platform to customers to sort of increase wallet share. And I think that is an investment which we have made, which is bearing fruit. And I think these are the 3 dimensions across which we'll work on the corporate bank.
So is it right to say that you are kind of reducing the risk profile going towards working capital and, lower risk segments here?
I think if you look at our incremental sanctions, which we keep putting out, we always keep saying that more than 80% of the sanctions are to A-rated companies and above. I think that would continue.
So does it mean that going forward, the ROEs in your corporate book may not be as good as what you've seen in the past?
Not necessarily, right? Meaning if you look at overall revenue profile, the revenue profile can change, but the returns can still be quite good.
And certainly we expect much higher through the cycle ROEs, Venkatesh, which is the key reason why we are doing this. We truly believe that on a risk-adjusted return on capital basis, through the cycle, the kind of business that Srini is describing, smaller ticket, working capital, flow-based, lots of non-fund-based income, fee income, liability side profile, and limited exposure on the project or long-term term lending side, and better rated corporate. That profile of business through the cycle does give better risk-adjusted return on capital.
Because you had mentioned you're looking at something like 18% ROE on a medium-term basis. I guess
yes.
18 on retail side is pretty much achievable, but you think this business can also achieve an 18 sort of ROE?
Yeah, between this and SME, yes.
Okay, that's one. The second one was slightly on a different topic, not so much to corporate and the NPA topics which have been going on. On the insurance side, what are your thoughts on your tie-up with Max? It's a couple of years for renewal, but what about your own manufacturing versus thoughts of getting a stake in Max and going ahead with Max for longer duration? What are your thoughts on that?
Sure. See, Venkatesh, if you look at our FY19 execution strategy, that should tell you what our big focus areas are. And we have talked about the 4 vectors, and in the short term, given everything that's going on in the bank, it is important for us to remain focused and try to do a few things and get them right in FY19, and that's why we have put out these 4 vectors. And at this point of time, we are comfortable with where we are on our relationship with Max, and I will sort of leave it at that.
Because at some point, a few months ago, you were talking about manufacturing or your own project. So is that on a back burner right now?
Well, what I'd say is that the deck on execution strategy appropriately covers in the new context where we are as a bank, what our key sort of focus areas are, and we want to remain focused on these and deliver them.
Okay. All right. Thanks so much.
Thank you.
Thank you. The next question is from the line of M.V. Mahesh from Kotak Securities. Please go ahead.
Hi, good evening to all. Just very few basic questions. One, slide 52. When you look at Q3FY data on the non-MPA book, the vulnerable pool, that number is actually lower. 15,926 is lower than 16,120, which you have in BB and below advances.
Oh,
and the same is true for 1Q. Whereas if you look at the previous quarter's presentation, you had an additional 1,337 crores, which was in various restructuring dispensations as well.
No, that's a good catch, Mahesh. No, that's a good catch. I think there's a typo there. I will need to correct that. Sorry. I think there's one digit on which there is a typo. We will get that corrected and re-uploaded. Good catch.
Sure. And I think the same is true even for 1Q FY18. So if you can just recheck that table. Second, Q1 FY18. Again, you just look at these numbers because just trying to understand how can the...
Oh, yeah. You're right. I think there's a typo on a couple of in these. Apologies. That's a good catch on your part. I'll fix that and we'll get that re-uploaded tonight.
Sure. Second question, just a couple of very basic ones. Provisions breakup, if you can just kind of give that. And the third, provisions and the security receipts that you have outstanding. And the development that was happened during the course of the quarter, you increased savings interest rate on select quantum, but we didn't see any response from some of the few large competition out there. Was there any specific segment of business where you thought there was vulnerability? And also, why did you lose the bullion license from RBI? Thanks.
Man, those are a lot of questions. I'll try and sort of remember all of them. The provisions breakup you see on slide 62. It's a regular slide we present. So if you go there, you should see for quarter on quarter what the No, that's all right. What the split is. And your second question was on
security receipts outstanding.
Security receipts outstanding is 2,900 crores or something like that. That hasn't changed in the last multiple quarters. And your third question was what?
The savings account change and the bullion license.
Savings account change, there is a particular segment in which this is not a defense thing, it's a playing offense thing. There is one segment in which we were seeing and are seeing some opportunities, and hence the move. If it works out, it works out. If it doesn't work out, we would be perfectly happy to go right back. So we will see. We will see whether that particular segmental play is working out or not. On bullion, well.
See, there's an annual review which RBI conducts, and we are working with RBI to see what best to do in terms of renewal of the license.
Okay, done. Thanks a lot.
Thanks, Mahesh.
Thank you. The next question is from the line of Krishnan ASV from SBI Cap Securities. Please go ahead.
Hi, Krishnan.
Yeah, hi. Thanks for taking my question. Two questions that I have. One, I just wanted to understand, is there an element of discretion in how much of recognition has gone through in the March quarter? If yes, then why would you still have, say, 9,000 odd crores of BB and below? Why would you not recognize all of it in one go? That's one. The second question is just your retail strategy. A lot of, your investment thesis is now anchored on the fact that it's a low credit cost business that you're building, and hence, the next cycle credit cost will be significantly lower than what we have seen in the past. Just want to understand what's been your strategy in building that retail book. Are we missing out any red flags? Are we making the mistake that we might have made in the earlier cycle as far as corporate lending is concerned?
Sure. Thanks for your question. The first part of your question, if I understand it right, is, hey, you guys seem to have gone a particular distance in terms of cleaning up the book. Why not go, quote unquote, the whole way? See, our thinking is we have done what we think is sort of appropriately conservative. We have tried to be as conservative as we can, identify pockets, where there was incipient stress, and recognize it within the limits of the regulatory guidelines. We think this is the most appropriate thing, for us to do. There is always going to be a line that you draw, and there are always going to be some accounts just on the other side of that line. So it's sort of a never-ending process of saying, why did you stop here and not do 5 more accounts? We did what we think is sort of, wherever we had, significant worries and risks, or, where we saw that there is incipient stress building up, we took action. Also, it's important to point out that a vast majority of the accounts that slipped in this quarter are not NPA with any other bank in the industry as per CRILC. So we are in effect the first bank to term all these clients NPA, and so we have in that sense gone out kind of off the fairway quite a bit in recognizing stressed pools and identifying them and marking them as NPAs. So we've done basically the best that we thought as appropriate. Srini, you'd like to add something?
I think it's not fair to assume that any asset which is double B rated is going to slip. I think that is also not a fair assumption.
It almost seems like that, Srini. If you look at the track record that we have had over the past few quarters, it does seem to imply that there is a very high chance. That's the reason why it's called double B and below, because it is it's below investment grade.
Sure, no, it makes sense for you to sort of make the appropriate assumptions. As we have said, double B is about 1.8% of customer assets, right now. Whether the eventually, and it used to be whatever 7.5% or whatever it is. If is it going to eventually settle down at 1%? Is it eventually going to settle down at 0.5%? Is it going to settle down at 30 basis points? I don't know where it is going to settle down. You should make your own sort of assumptions on that one.
Okay, fair enough. The second question, please. The retail build out that happened.
Oh, yeah,
how are you making sure that you are?
Yes, thank you. Retail. See, we've in retail we have a portfolio mix which is made up of many businesses. So retail is not a single business entity. It's a sort of weighted average of a lot of different businesses, all of which have very different risk return profiles. So you've got to actually constantly look at the risk return sort of mix on that. Our key thinking from a risk management perspective in retail has been sell to your deposit customers. And that's why we place so much emphasis on how much of our business came from existing customers. We talk about it every quarter. We show you the trend lines. And the design principle has been the more unsecured the product, the greater the proportion it should come from existing clients of the bank. And that's why you see businesses like credit cards, we do 100% from existing clients of the bank or existing deposit side customers of the bank. Similarly, a product like personal loans, you will see 75% of it coming from existing customers of the bank. But a product like home loans, which is is at the other end of the spectrum, you will see maybe only 40% of it coming from existing customers of the bank. But even there, the proportion will be at least 40. So that's the core design principle, is you first get a deposit account, see throughput information, and identify clients who are risks you want to take, and then cross-sell to them. That strategy has worked well for us so far. And if we look at the quarterly information that we get from credit bureaus in terms of how retail customers of Axis Bank behave when compared with the same vintage retail customers of competition, we feel very good about the data we see in terms of in terms of the overall risk levels, and so we feel very comfortable with the kind of portfolio that we're building right now.
Okay, great. So is there a rating imperative here, given the kind of delinquencies we may have, we have recognized in Q4, and we are indicating we may have to recognize in the first half 19? Is there a rating agency imperative here?
See, you look at the overall ratios of the bank. You look at the net NPA ratio at 3.25. You look at the CET1 ratio at roughly 11.68. You see the overall capital adequacy ratio at whatever 16%. The ratios are all absolutely spot on. There is no, and you look at the incipient stress book, which is pretty much the lowest it has been in a long time. And as I mentioned in the call, an SMA book, which is less than 50 basis points of loans, pretty much no large ticket size loan left in the vulnerable pool. So those are facts, and we will as a lending institution and as an institution that gets its borrowings rated, we will continue to always be in touch with rating agencies, but the facts are pretty self-evident.
Thank you. I would request Krishnan to come back and give a follow-up question. We'll move to our next question, which is from the line of Mayank Bukrediwala from Goldman Sachs. Please go ahead.
Yeah, hi, this is Rahul here. Sorry for belaboring on this point. So the retail and SME slippages that we saw in this quarter, can we have a broad breakup between how much was from, say, core retail and how much was from, say, SME?
Yeah, let me give it to you. Just give me a minute. SME is 67 and retail is some 490 or something, right? 491.
Okay, so out of 2,600, 491 is retail and remaining is SME.
No. I'm talking about the net slippages, Rahul. Net slippages, okay. 491 in retail, 67 in SME.
Okay. Can you give it on a gross basis as well, if possible?
I don't have it readily. We don't usually share segment level gross things. But see, the broad thing is, and this is the reason why we don't do say retail and SME on a gross and net basis. Fundamentally retail, you do see a lot of gross and a lot of recoveries and upgrades happen in the same quarter, and hence the net number is always low. This has always been the trend. There's absolutely nothing new in that in this quarter. There is one. You heard me mention last quarter's call that we are making, and we are making a small change in the way we kind of recognize in the retail and the smaller ticket accounts that fast forwards some of the recognition process. You see some effect of that in the gross number in this quarter, but as you can see in the net number, that doesn't make much of a difference.
So from the subsequent quarter, this number you think will come down to 800 to 1,000 crore that we've seen in the previous quarter?
I think that you will see the net numbers fairly stable. You're not going to see the net numbers move. You might see the gross numbers move a little bit, but you will see the net numbers pretty steady.
Understood. The second question, again, the BB and below pool, the flow into that, so that was about 5,500 crores. Now, again, you made a very pertinent point about the upgradations going into that pool. Now, same thing would have been seen, say, in the last few quarters. So if one were to compare on a sequential basis, then how would have that number moved? Can you give us some sense around that, please?
Only in the last 2 or 3 quarters that you have seen any upgrades at all. So in the quarters prior, that dynamic is actually not relevant. It's only in the last couple of quarters that it's relevant, more so in this quarter than in the prior one. Last quarter, you probably had about 1,500 crores, getting upgraded into BB from NPA. This quarter, you probably saw about 2,500 crores of that nature. In the prior quarters, you can pretty much ignore it. It wasn't really very much.
Okay, and this is the run rate, that you think will kind of continue from. So the reason I'm asking is, we've been emphasizing on this point of building, better rated profile, kind of a corporate book, and this number, at least on a ratio terms, appear, slightly at the higher end. So, hence this question.
Sorry, which number is high, you think?
The slippage, the movement into BB and below. If I were to, use the corporate portfolio.
See, from BB, you mean?
Yeah, correct.
Yeah. So that point is pertinent. And as I mentioned before, that the movement from BB into BB has been, on a net basis, has been kind of around the kind of 2,500 odd, range, and that is not an acceptable situation on an ongoing basis. If it continued to be the case 3 quarters from now, that would be disappointing. And that's why every quarter, 2 quarters ago, I said, hey, we think about 4 quarters is left. Last quarter, I said, hey, there's about 3 quarters left. And this quarter, I'm saying there's about a quarter or 2 left of that sort of downward migration of ratings from, so our story on what is the pipeline of potential downward migration of ratings. That hasn't changed in the last 3 quarters. That pipeline is reducing, but it's not down to zero yet. There is another quarter or two of that level of downward rating migration that is still left, I think.
Understood. All right. Thank you so much, Jairam, and wish you good luck.
Thank you, Rahul.
Thank you. The next question is from the line of Ravikant Bhatt from Emkay Global. Please go ahead.
Yeah, hi. I would like to first, take up the previous discussion which happened on the net interest margins. Your domestic NIMs have stayed quite stable quarter on quarter. Now, in a quarter where you have had significant slippages, and you did mention that there would have been interest reversals on account of the high slippages that you have recognized. Despite that, your NIM staying stable, it's just about down a basis point, is a bit perplexing. So, what other factors, next of slippages, what would have really contributed to this stability? Because in the previous quarters, when you have had slippages, I think the NIM was actually declining quite rapidly.
There are 2 elements to keep in mind here. One is the fact that, there are slippages, proportionately more slippages, compared to the proportion in the portfolio, there have been more slippages in the overseas book. So you see the overseas margins actually compress
yes,
meaningfully. So that does reflect that. The other dynamic to keep in mind is compared to Q3, we have a full quarter's benefit of the capital raise in this quarter.
Got it. What would have been the slippages in the overseas book, if you can share that, of the total slippages?
We don't share that on a overseas versus domestic basis, unfortunately. Sorry.
No worries. My second question is on the management change, which has been triggered by the regulator, if one were to go by what has been reported in the media. Now, I guess this is only the second instance wherein the regulator has been at a disagreement with the bank, the previous one being the divergence on the asset quality. I think it would help if you could, just briefly let us know what exactly was the discord or disagreement that the regulator had. And you have a fairly strong bench strength. Why was not an internal candidate considered for the post of CEO? Why go into a longish 6-month kind of search for a new CEO from somewhere else?
See, the second part of your question, unfortunately, we cannot answer. It is not appropriate for management to take that question. It is. I think it is absolutely appropriate for a board to look at the entire talent landscape to figure out future leaders. So, it is the board's prerogative to look at a broad spectrum, and it is not for us as the executive team to comment on that. As far as your first question is concerned, in terms of regulatory conversations, any specific communication that a regulator might have had with the bank is in this regard is privileged information. It is impossible for us to talk about it. But broadly speaking, Shikha has been here for 9 years, and there was a chance that she could have stayed for a little bit longer. She went ahead and requested for that time to be curtailed, and that was accepted, and that's that. I don't necessarily want to go into the details of why that might be, etc. We are moving on as an organization. We have, as you said, the management team, the employee base, the customer franchise to have a successful business going forward, which is independent of any individual. And what we have tried to articulate in our strategy presentation for FY19 is that we also have a fairly clear strategy of what we are planning to execute on in FY19, irrespective of what happens in the corner office.
Sure. Thanks, Jairam. Wish you the best.
Thank you.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Hi, Manish.
Hi, sir. My question on the overall credit cost you talked about in last year when the beginning of the financial year FY18, the credit cost guidance was 2 to 2.5. The overall credit cost for the full year is worked out much higher. Now, we know in this quarter we have taken escalate provision on the incremental slippages. Now, when you say this normalization of credit cost, and the first half there will be some continue NPA will be there. So in terms of normalization, it will be front and the provision will be very heavy in the first half, and there will be a sharp decline. How it works?
Quarter-on-quarter credit cost guidance, but the reason why we have been reticent about actually talking about any earlier reversion to normalcy is that one doesn't know exactly how the IBC process is going to play out and how the resolution cycles are actually going to happen and how long they're going to take. But if your implied question is, hey, is there sort of any more quote-unquote deep recognition exercise that's going to happen in the first quarter or two, the answer is no. That is not, from a recognition perspective, whatever we saw and what we think needs to be done is done in this quarter. We will see, but we are not at this point of time guiding to sort of immediate reversion to sort of long-term business as usual. We think it will take a couple of quarters. We will see how it goes.
Secondly, what kind of corporate loan book growth we are looking in FY19?
We'll see. There's a lot of opportunity right now. At an overall level, we're looking at a high teens to 20% kind of loan growth, and we think a lot of that is, a lot of corporate opportunity exists right now.
So because some of our peers are growing very aggressively corporate loan book growth, so from that context, whether we'll be growing 20% kind of loan book on our base or it will be much lower?
See, we don't have a growth target. As I mentioned during my opening comments, from a book shaping perspective, we wanted a particular kind of balance in the book. We have already achieved that. At this point of time, there is no grand design in terms of what we want the overall kind of proportion of book to be going forward. At this point of time, it's all going to be about where the right RAROC is. In whichever segment we see the right RAROC opportunity, we will go pursue it, whether it's retail or SME or corporate.
Thank you. I would request Mr. Oswal to come back in a queue for follow-up question. We'll move to our next question, which is from the line of Pritesh Vora from Incido. Please go ahead.
I'm coming back to, again, the asset quality. You mentioned the gross NPA movement there. So can you tell me exact amount coming from the NPA asset upgrading to BB and degrade from BBB to BB? What is the exact?
Roughly about 2,500 crores.
Right. And from BBB to B is how much?
Both of them are roughly the same amount.
All right.
I mean, just coincidentally, they are both the same amount. Yeah.
Okay. Thank you.
Thanks.
Thank you. The next question is from the line of Rakesh Kumar from Elara Capital. Please go ahead.
Yeah. Hi. Thank you. See, just looking at, long-term trend in the margin or maybe the credit yield, what we have seen is that, since FY11, we always had, a rising margin and rising credit yield, even though, there was a pressure building on the credit quality side. So it's, very contradictory that, or maybe, we are building more risk on the book, on the other side of the book. So, and still we are, for the next year, we are again guiding for the stable margin. So could you just, elaborate on this issue?
I'm not sure I understood the question, to be honest. See, the way we see it, as credit quality gets better, the proportion of your book that is non-interest earning will reduce, and that should expand your margins. Also, as the rate environment, if it's on an upward trajectory over the course of the next year, your margins should have an expansive trend. As you've seen, about 50% of our book is now on MCLR, and our MCLR has been going upwards. So all that has margin expansive influences. But as we move the corporate lending book more and more towards better rated clients, that will have a margin compressive effect. The net of this is what you will see in the overall margin trend, which we are broadly guiding for stability in the next year. I hope that
we understand. But thing is that, since FY11, if you see, maybe FY15 or so, the gross NPA number rose from 1.1% to 5% kind of a number. But still, the credit yield number is rising. So it's again we are saying for the next year that, we will maintain the margin. So, are we building some risk on the other side of the book? That is my limited question.
Then when you say other side, which other side you mean?
Maybe on the retail side, are we building on the more risk on the retail side? That is what I want to understand.
No, the short answer is no. I mean, I don't think I'm fully understanding the math of where you're coming from, but essentially, remember importantly that the gross NPA metric that you're looking at doesn't impact margins. The net NPA metric impacts margins, and the net NPA metric has increased, but it is still only 2.3%. So it's not. 3.4%. So it's not. It's not increased sort of to a level where it will start having that big a sort of visual impact on margins, and that has happened. And the reason why net NPA metric hasn't risen as much is because we are paying for the increase in NPA ratios every quarter by keeping high provision coverage ratio. So if the higher you keep your PCR, the lower is the impact of credit risk on margins. And because we have kept PCR very high, you don't see the margin get impacted as much, even as gross NPA ratios go up.
Okay. Just one more question. On the second half, we have guided for close to 110 or 100 bips of the credit cost. What would be that number in the first half?
We are not guiding on a quarter specific or first half, second half credit cost. Thank you.
Okay. Thank you.
I think Margaret, we're pretty much out of time. If you're
sure, sir. Would you like to add any concluding remarks?
No, I think we're good. Thanks everyone for very active participation in this quarterly discussion. I hope you have a very nice evening. Thank you.